is intended for potentially for a global audience, but may not be suitable for everyone. So to find out if it is, take a look at this link, admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity to find out more about conditions and details and if it's suitable. Also, trading foreign exchange and global financial markets are considered high risk and may not be suitable for everyone. Please contact an independent financial advisor for more information on that. This webinar is not advice and is for information and educational purposes only. And by continuing watching this webinar, you agree with this disclaimer. Oh, apologies for that. And the disclaimer is somehow not fitting within that page. I don't know why. Something happened. Let me just quickly adjust that. It'll take a second. There we go. Good. So let's continue. This is this disclaimer. Today we're going to take a look at market structure. This webinar is presented by Admiral Markets. And what is market structure? There's many ways of looking at market structure. One could even think about supply and demand, Elliott wave. One could think about trend and momentum, or momentum and correction, for instance. So everyone is going to have a bit of a different interpretation how to do that. So first I'm going to share my views on that, and then Nenad is going to share his after that. And basically, it sounds maybe like a bit of a fancy word, but it's just simply looking at the chart and understanding what the flow is, what levels could be important, so that we have an idea of about a roadmap, basically, right? Because when we look at the graph, right, and the price, that's the market, right? The price is the market. We see all kind of movements like that, and that's basically just the structure. So market structure, right? It sounds fancy, but it's just a simple term, in fact. So when we look at this chart, market structure is just a way to say, okay, how do I read this chart? How do I understand this graph a bit better than just maybe some random noise when we look at it? So that we have a bit more feeling for what could be going on, right? And in that regard, it gives us kind of a way to say, okay, like a roadmap reader, I expect here potential trade to the downside, and I might expect here trade to the upside potentially, and here trade to the downside. Gives you kind of an idea about what trades could be interesting, what trades could be this week on the table, and then you dive into maybe lower time frames and use price action and perhaps a trend line to be very specific with some setups. That's how I do it, at least. We did that on Tuesday. We looked at wave analysis, kind of made some ideas about potential zones that are interesting, and but use that more as a general guideline and a roadmap. Just like if you're taking the car, well, nowadays GPSs, but in the past where you had a map and you really had to understand the terrain and find your way across that, we're kind of the same roadmap reader with price. So I use three things. Basically, trend and momentum, support and resistance, and patterns. Those three, I think we can understand kind of what's going on the chart very well by using these three things. Trend and momentum, support and resistance, and patterns. And if we have an understanding of that, if we can read the chart with these three things in mind, I think that we're doing a great job about and as being a technical analyst. So, for instance, if you're looking at trend, it's going to perhaps at one point hit a support or resistance, and that's a clash that could be important. Or a pattern at a support or resistance could be very a telltale sign for a reversal if it's a rising wedge, or if it's a bull flag, it could be a continuation pattern. All these things add up to the analysis, or if there's a pattern in a trend, for instance. So there are a lot of combinations here possible when analyzing it, and just to give you an idea what could be going on. These are just examples, right? So let's talk about this a bit more. It's almost like the smallest building block is the candle itself. Every single candle that appears on the chart is kind of like one piece of the puzzle, right? So we're going like every candle, we're getting more information, and we're getting a bit more idea about what's going on, perhaps, but it's like the smallest unit available. The candle pattern already could include 1, 2, 3 pattern, so you're already getting a bit more complex kind of combination. And then you get the momentum and correction, which is basically already grouping together multiple candles, sometimes up to, well, it could be a lot. It could be 40 candles. And momentum could be 10 candles. But you're grouping already a lot of these candles in a row, and you're kind of labeling them together. When you have a momentum, right, like this, for instance, most candles going up probably, right? We consider that a momentum. Well, those are all like about 10 candles, but we consider this kind of like one leg. It's one momentum. So that's already kind of a higher unit or a bigger building block within our chart, right? Chart pattern 2, it's already looking like a triangle. That could take, if it's a daily chart, it could take very long. It could take months, right? That's a big unit on the chart, isn't it? And in the trend, of course, depending on what time frame we look at, could be something like this, right? Of course, that could be a year or perhaps 2 weeks, depending on what time frame we look at. But we're looking not only at a momentum, but also at a correction, and then another momentum, and then again a correction. You see, so it's even bigger unit. So combining all these things is the way I think this is just to explain, how you can understand kind of the DNA of the market, right? So let's talk about this a bit more in detail. Momentum and correction. I want to just talk about now. I use it often in live webinars, and it's a way of understanding whether candles are going quickly, moving quickly, or slowly. If they're moving quickly, that means they're often going to hit our stop loss or TP within a reasonable quick amount of time. And correction is just kind of like sideways price movement, choppy. So impulse would be more like this, for instance, or like this, and a correction would move more like this, right? All right. Now, momentum and correction are building blocks, again, for using a wave analysis. But that next step, you don't necessarily have to do. Not everyone wants to do that, or you not necessarily must do that. You can still use momentum and correction, just without even thinking about wave analysis, and just use that as a concept as it is to understand what's going on with the market. If you like it, and you think that you want to go further with that, and you want to maybe use a different dimension and a theory that could explain a bit more about it, then wave analysis might be for you. But it's not necessary to still use this, right? Momentum and correction. It's kind of like there's always two things that the price can do. It's either it's pausing or it's moving, right? It's resting or it's speeding up. So it's very important, I think, to understand that so we can know what's going on with the price a bit better. So I want to explain this first before we dive into more details about the market structure. Momentum is basically how I define it. Most of the candles are in one direction. So you're not going to have a mixture. It's predominantly the candles will be either bullish or bearish. So if you look at a bullish momentum, most of these candles, are going to be bullish, right? They're going to give you maybe a couple of ones that are not. But obviously, if it's 50-50, it's not. If it's something like this, it's clearly bullish momentum, right? You also have typically, in the direction of the momentum, bigger candles. So look at these small red candles and compare these to these, bigger green ones. That is an example of how momentum typically has, what am I doing? Typically has bigger candles. Look at this 4-hour chart, perhaps, right? Look at this upside. There's a lot of fibs here. But okay, just ignore those fibs for the moment. But you see, or maybe I should just clean up the chart here just quickly, 1 second. You see that when you look at this 4-hour upside, this is momentum, right? This is a momentum. More candles are bullish. More candles to the upside are bigger. Look at this particular candle right here. Where is it? Here, this one. See this one here? Right? That is a big candle. You get 3 small candles. Not even breaking the low. So obviously the dominant direction here is up because we got a big bullish candle closing at the high, and there's like teeny kind of candles after that are hardly, they're a bit bearish, but they're more like dojis, That's a clear indication of upside momentum in this case. and the close is near the high or the low, indicating control. Because if it closes near the high or low, that means in most cases there's a good chance that that side is clearly in control and not losing that dominance. So you got a couple of candles momentum, but more candles are normally corrective. It typically lasts longer. You got candles that are mixed of direction. You got smaller candles. You got indecision candles. You got dojis. You got closes out. Then obviously near the middle of the candle. It occurs often. It takes longer. You got chart patterns based on those corrections. So I think that should be clear. Let me show you an example. Let's see. All in all, in fact, if you look at the daily chart, right, we had a correction here on the euro dollar. You see this part here? You see clearly down momentums, right? We had most of these candles were bearish. Most of these candles were big bearish. Most of them were closing near the low, and only a few smaller bullish candles. Then we had a candles mixture, right? Mixture of candles, smaller candles, closes sometimes near the high, but it's also more of a mixture, right? Clearly, we had a sideways move here, right? That was a correction. Even actually between these two levels here, it's maybe a bigger zone, but this too, all in all, was a correction. Still is, perhaps, right? Although it has a bullish slant at the moment. So is that everyone on board on this part? Perhaps before I continue, I'll move on to a new topic now. Any questions? Everyone clear on this? For those that join my webinar, I think it's something that I talk about regularly, so that is probably all good. Great. Cool. So let's take a look at trend, reversal, and range. Basically, momentum is one part, but then we have trend, right? So we basically, within trends and reversals and ranges, we see both happening, the momentum and the correction. But typically in a trend, the momentum will be dominating in one way, because what happens is that we'll see an impulse, we'll see a correction, we'll see an impulse, correction, impulse, correction. But the impulses to the upside will have more steam, will push further, and generally we'll see a channel like that. So there is an uptrend, and we will see upside momentum going further and happening more often. Doesn't mean that downside momentum cannot happen, but more often there will be bearish corrections within this uptrend. In a range, we could see both as well. What could happen is that price is doing something like this: impulse, impulse, for instance, impulse, upside, downside impulse, downside impulse, sideways correction, downside impulse, upside impulse, sideways correction, upside impulse, and it does kind of all of these things within this range. And then a reversal, it could look something like this: a very steep momentum down, and we see kind of a corrective upside first like that, and but all of a sudden it starts to break to a higher point. Right? This starts to corrective, but then accelerates to the upside, and you kind of get a bigger reversal correction of this downside. All right, so even in those cases, there tend to be a mixture. That's why it's also not that easy sometimes, but definitely, obviously, when we use this and look at it more often, we'll get better at it. Wait, let me take a look at a live chart here. For instance, perhaps on the daily chart, I like using trends on a 4-hour chart. Maybe we can find one here quickly. For instance, here. It's kind of cutting through those candles a bit. It's not always equally precise. Moving averages are sometimes also convenient because you don't have to kind of like be all too cautious about if price is neatly fitting in the channel. How the channel looks like is again a different topic. I don't want to. That would be a bit too wide of a topic for today. But let's say a channel like that. It's an upside. You have some upside correction, some downside, upside momentum, downside correction, and etc. Here a bit of downside momentum and upside momentum. So you have that pattern here on the trend. Right. So that's an example of that. Let's see a bit further back, perhaps. We had here, for instance, a channel, and actually what happened was almost an acceleration below this channel here, and the channel actually gets expanded to even a wider one, right? And then even a wider one. So a lot of bearish momentum, as we know, on the euro dollar. Right, but that all started with the channel to the downside. And in that regard, we're still in that wider channel. We're actually still in that wider channel, getting close to the top, perhaps. Right. All right. So that's how you can look at channels. You can see that they have momentum and correction in them. Alrighty. Now I'm going to tie this all together. Just hang on with me. You can use, for instance, moving averages or these trend channels I just showed you to define the trend. The range is often a pattern that you have to look for, and a reversal, you often see divergence in the charts, right? So typically you will see these three things occur, and that will help you identify what kind of environment is going on that particular pair. So let's take a look. For instance, on this euro dollar, right, we had divergence between these two bottoms right here, right? Indication that perhaps a bigger correction could happen, especially, by the way, in my opinion, after FOMC had a bullish day here, right? And we're already talking about the fact that that could be the end of this downtrend. We could see a bigger correction. So far, that has proved to be right. Divergence is part of that reversal, right? If you look at ranges, for instance, right in here, this range, we said at the time that it happened, a close below that would be a good breakout. That was the end of February. And indeed, we got one more rally down. All right, so typically that's a pattern. In this case, it was more of a rectangle pattern. So you can use chart patterns to identify with the trend continuations in that case. And last but not least, moving averages for the trend or the channels I'm just using. But let's use the moving averages now. A bit of a higher moving average, like 144, for instance, is what I use, indicating more the trend. On the daily chart, that's a bit of a high moving average. It's something more maybe usable for a 4-hour chart here. You can see, for instance, this is what I use personally. And you can see that price went back to 144, retraced from it, and then started to break above it. Right? Lower moving averages are still useful, by the way, but more maybe perhaps for measuring momentum. Like if we use this one, for instance, the 21 moving average. Let me find a good color for that. Then you can see that that kind of gives a good indication of momentum on this 4-hour chart. So you can, that's why I use these moving averages to gauge the difference between trend and momentum. Right? Here you can see the 21 is above the 144, price is above it, so we have up momentum at this point. We have here, we have a uptrend and up momentum all the way up to here. Then when price retraces back here, this is a correction because price is going against the 21 EMA, right? And it's also going against the trend. It's a corrective bearish correction, basically. Ultimately, we have 4 things we can see. We can see a bearish correction, wait 1 second, a bearish momentum, bullish momentum, a bearish momentum, bearish correction, bullish correction. And the best ones, of course, are bullish momentums with a trend, bearish momentums with a trend, and these corrections are typically best if traded, if possible, with the trend as well. Second best would be momentum with corrections. They also sometimes have a lot of pace. And last but not least, also, of course, if you have a good range, the resistances and supports could provide a lot of valuable places for trades as well. Oh, anyhow, 1 second. I don't want to go too much off the track here. Let's continue quickly with support and resistance. Support and resistance then is the last step, basically, right? We were looking at trend, momentum, and no, it's not the last step. Sorry, it's the third step. Still patterns after this. Support and resistance. Basically, we're looking for confluence of levels. We're looking for an area where price could or has a high chance it will not be able to break and continue. That could be, the more confluence, the more tougher it's going to be for price to get through it. The more assured we can be that that is indeed a big zone, that means that from a market structure point of view, the trend will probably last to that point, and then the trend could be over, or the trend could encounter a serious pullback. A big level basically can cause either price to go back for a small pullback, a big pullback, or a reversal. A small pullback I define as price going back to the 21 EMA. A big pullback would be price going back to the 144 EMA, and a reversal would mean that it's actually going below or above, like past that 144 EMA. So if we go back to this chart, basically this is a small pullback at first, retracement. This is a big pullback, retracement, and then this is the reversal. That's how I define the this particular effect. Now, why here? Now, 105, perhaps a psychological number, perhaps some fib targets. The idea is, in any case, the more confluence, the better. Of course, you need to be careful that you're not using 1,000 tools and you'll see confluence everywhere. But within a reasonable kind of amount, we can look for strong levels. I use fibs a lot, fib targets. I use just classical daily bottoms and weekly tops, the tops and bottoms, sorry. Perhaps strong pivot points, confluences. All these things are good. Is the sound okay at the moment? Does everyone have good sound? Just checking. Jen does not hear me. Is the sound okay? Yes. Sounds good. Okay. Thanks, Yushins. Oh, good, Jen. Great. Thanks, everyone. Cool. The 144 EMA is based on fib numbers, basically. So I like Fibonacci moving averages. So anything that is part of the Fibonacci sequence, I would consider using. And 144 to me seems like a sweet. 233 is on the high side, and 89. I even used 89 in the past. I went back to 144 after using the 89 for a while, just because it gives a bit more space for price. It seems like 89 was a bit too quick. 233 is maybe also option, but it's again slower. So it's all the idea is fib numbers basically. Alrighty. So, and then we got patterns, which, let's see, I don't know. Well, patterns, in any case, is of course a lot of range of patterns. We have candlestick patterns, chart patterns. Chart patterns, we have triangles, wedges, flags. I'm not going to show every one of them here because it's not really the point. It's more to tie things together. I think we have a separate webinar just on patterns. But patterns obviously we can read the psychology of the market from it, and we understand just by looking at patterns what could be going on behind the scenes, right? A rising wedge, lack of enthusiasm for the upside. So basically, if we look at these three things, or four things perhaps, I think we have a good idea about the roadmap. Momentum or correction, right? We realize what the past leg was. Was it an upside swing like that? And what is now? Is it a chart pattern like this, a rectangle, or did we have an upside swing, but are we having maybe a zigzag correction? Right? That's momentum correction. Or perhaps we already have a couple of bullish candles and we recognize that we're in the momentum. That happened to us actually last week once in the live room. And the momentum still continues, right? And you kind of trade it maybe halfway or at the beginning. You don't want to trade it, preferably not at the too much to the top of the momentum. It can happen sometimes though. So that is, of course, you can look at the past kind of 1, 2, 3. You can look at as many swings as you want and label them. But the more you do, the more you're really becoming a wave analyst in a way, slowly but surely. But if you look at the last few at least, you got already an idea about it. And if you see a very strong upside and you see a zigzag correction, then we can safely, or not maybe safely, but surely, slowly but surely, maybe look for a bouncing spot back for upside here, right? Because we're looking for that continuation of that previous momentum. So you can already gauge with the speed of and comparing several swing highs about what could be the next one. You can look at the speed here in the upside, of course, is dominating, and then look for breaks and bounces just based on that. Then the candlestick patterns will show perhaps the end of momentum or the end of correction. For instance, we have momentum and we have a big pin bar here. That's a candlestick pattern that could show potentially the end of the upside. Time to take profit. Or perhaps if the trend is down, for instance, time to enter a short with the trend set up on a larger time frame, but on the smaller time frame, against the momentum trade. Right? That depends whether there's a trend and what the trend direction is about that particular part. But let's not make it too. Let's take it step by step. So we got momentum and correction, then candlestick patterns to show the end of the momentum or the end of correction. For instance, here, end of upside momentum, we got a zigzag pattern. Maybe here is a good candlestick pattern that shows, okay, that zigzag is over and it's over still, and I mean it's over at a point that this upside momentum is still dominating, right? Of course, if the zigzag will bring it all the way here, it's not dominating anymore. But if it ends up somewhere here at the 61.8 or the 50 fib, could be a good moment for that long after that candlestick pattern, right? Then you might want to consider what the trend is, the direction of the trend, right? I mean, you could have an up momentum and you could have a zigzag like this, but then if you look at the wider scale of things and you see something like this, a trend actually to the downside, then it doesn't look the same anymore, does it? Right? But if it's an uptrend like this, and you're at the bottom of the channel, you got another confluence. So the trend is again a bigger structure, and that will give you again another layer of information besides the fact that there's an up and a down and a candlestick pattern. Then we can look at chart patterns. For instance, let's say that we have an upside momentum and we have a zigzag and we have a uptrend channel like this, but let's see, prior at this, let me take a look at that. Here, prior to that, right, we have something like this. So it's a chart pattern in its own rights. Here, this part. And we can conclude perhaps that the chart pattern might bring it to, there's a potential, moment where the chart pattern could alter our view, right? We could perhaps look for a different spot to enter, or we might expect the end of the trend and not take any trades anymore. Last but not least is the support and resistance. So, for instance, we might have that uptrend like that, and we have impulse, and we have that correction, and we have a bounce spot here, but there's this major parity level. Well, then that's the support and resistance that could cause the trend to end, and we might want to be careful because of that, right? So it might seem kind of like a lot. Obviously, I don't know if it is or not, but if you do kind of combine all these things, I think you do have a good idea about what's going on, at least, right? And then some things, I mean, it's always a bit of give and take, especially if you trade discretionary. But I think if you use these concepts, at least you have a good understanding of what's going on. Let's see. Jen is asking, besides 144.89, I don't use the 2233, by the way. I just did talk about it, but I don't use it myself. I use primarily the 144, sometimes the 89, and I use the 21 or the 34, and I use sometimes the 5 or 8 or 13 for very kind of short-term momentum thingies. End of the trend, sorry. Sorry about that, that was a spelling mistake. End of the trend, or the start of the trend. Thanks for that. And overlooked that one. And let's take a look at the EURUSD live chart here. This week, EURUSD, for instance, what I do, let me give you what is a possible way, because it's how do you combine all this almost in a way, right? Because it's like a lot of concepts and a lot of time frames, so it would be maybe a bit difficult to, like where do you start and what do you do first in a way. So perhaps, and that's up to you, of course, but perhaps this is a good sequence. Like on a higher time frame, if you are looking more for swing trades, for instance, take a look at the weekly. What does the candle look like? Is it part of a momentum? Is it end of momentum? Is it in a correction? Just look at how is that candle positioned? Of course, if you're trading on a scalp or an intraday, you might want to look at the daily chart instead. A daily candle, sorry. So the Aussie, let's see. This is too busy. And the euro, for that matter, have bullish monthly candle. Well, the Aussie doesn't really have a bullish weekly candle. So perhaps let me use the euro because that's, I guess, a bit better example in that case. Alrighty. Here we go. So just looking at the monthly candle, we see bullish candle, we see weekly bullish candle, and is it part of a momentum? Not really. We see maybe a start of a momentum, but we also see that this is counter the bigger trend. So we could say that we're at the start of perhaps a bigger correction, to put it cautiously at the moment, right? A correction that has some momentum at the moment. If you look at the candles, we understand that the candle also broke through. Well, now I don't want to go too far. But just looking at the candles, we can simply read that particular part. On the downside, every week was pretty simple. One bearish candle after another. We knew that we're in a downside momentum. Another bearish candle. That analysis was simple. The momentum is still continuing. So plain and simple. Then perhaps go to, for instance, the 4-hour chart to look at a medium time frame to look at a trend and patterns. Right. So what are we seeing here on, for instance, in this uptrend here on the 4-hour chart? We see bearish momentum on the euro dollar, and we see that there was a downtrend on the 4-hour chart, but that downtrend broken and we went sideways. But we know that a sideways pattern within that, after such a down move, could still get a continuation of the downside, and we break that pattern, we get the continuation of the downtrend. Right? So you can do that kind of work on the 4-hour chart then, trends and patterns. Then perhaps just a slightly higher look at support and resistance. What are key levels on the daily chart, for instance, to be aware of? And then on the lower time frame, could be the area where we look for triggers and entries, the actual kind of concrete trading stuff. All right, so eventually, what we after doing this exercise, we're gonna get an idea about where are the spaces, where are bounce and break spots that are interesting, and eventually where are the most interesting trading zones potentially, right? Where are bounce and break spots, and where's space? Well, we know from the euro-dollar, for instance, on the downside, here was space, and then below it was space, and then below it again was space, right? And what was that was the wide open space there below it. And we know that based on this analysis that this was the break point, for instance, and that this perhaps was a bounce spot, or that this was a break spot for a bigger correction. So you kind of can get an idea about potential trades, bounce or break spots, and where the space is between levels, and if there's momentum and trend for price to get it there. This is just to get an idea, and then, of course, as I said, then we can use whatever tools, indicators, whatever trading plan to basically make more concrete trading decisions. The moving averages, they're exceptional moving averages, yeah, and close, and I also use sometimes high and low, by the way. Alrighty, that wraps up my part for today. If anyone likes Elliott wave analysis, because it kind of like touches it a bit because of momentum correction, I didn't dive into that because it would be too long for this webinar. Then I encourage you, there is a webinar a while ago, I think like maybe 1.5 years ago, 2 years ago, that I did once. So maybe you can find that one. Otherwise, we got wave analysis every day on the site, on the Admiral Market site, and you can sign up for weekly wave counts as well. And I think that that could help. We even have an ebook on wave analysis. So if you write an email to Admiral Markets, then I think that they should be able to send that ebook that I wrote about wave analysis if you find it interesting. So if you want to follow up on this, you can do that through that. All right, and in the meantime, then I will switch it now to Nenet's screen.
Thank you, Chris. Great presentation. So I will continue.
Alrighty, Nenet.
Yeah, thank you. So
yeah, thanks, mate.
So let's continue with this presentation about impulsive moves and corrective moves. I will use a little bit different perspective for explanation of impulsive and correction moves, especially because I know that it's a lot easier to use it with, for example, Heiken-Eshi candlesticks. So I will be short with the explanation of impulsive and corrective moves because Chris has already explained, and you probably know that impulsive moves are trend moves, moves which go in trend direction, and corrective moves are effectively retracements within the trend. Okay, one of the reasons why I'm talking about this now is that you probably saw that euro dollar went to 120.30.35 today, and what happened is it was strongly bought for some 60 pips afterwards. So the thing is, we will use that example. Euro dollar is still in uptrend at as long as it's about 1.1065, it's bullish. So this now looks as a correction, and until it breaks 1065, we are bullish. That is basically a trend and retracement within a trend. Okay, but of course, if you trade lower time frames and Heiken-Eshi candlesticks, you can trade basically both directions. Okay, So impulsive price move is basically a forceful or strong move, which is usually in one direction. I sometimes call it a direct jump or direct fall because it is fast and powerful, and it produces big candles, and it can be seen on any time frame. It's usually followed, okay, by several candles, and those several candles are usually moving in a trend direction. Okay, we can also see a bulk of them in one move. The candles are often signified by closes towards the top or bottom of the candle, and it depends, of course, on the direction of the impulsive move. Okay, trading with impulsive moves is faster, and usually when traders want to trade impulsive moves, that means that they're trading breakouts. Okay, and usually that can be a double-edged sword, as you know, because if you join in on a freight train, you can make some pips, but very often you can basically come to the end of the passive move and the start of correction move, and then you can lose that steam and lose the money. So it's always best to align momentum and align corrective moves with the trend, and then you go in the, of course, trend direction. So trading without impulse moves is faster. It can give you, of course, some money, but the thing is, if there is the end of impulse move, there is always a correction, and then we can start to lose, right? As I already said, that is that big money is running through the markets, and the thing is, when big money is running through the market, we are following the trend, as always. Okay, impulse move is very forceful, and it uses a large amount of capital. Okay, impulsive move has direction. Okay, impulsive move has a momentum. It has a strength, and sometimes it shows wicks, but lower or upper wicks depending on the move. So if you see that the price is making basically a higher highs with higher lows wicks, you know that impulsive move is happening. All of this is very clearly seen on Heikin-Ashi candlesticks. Okay, impulsive move means, and usually that signifies a huge stop grab, because tripping stops will create price moves. Okay, we can usually see then when there is impulsive move, the price moves so furiously that it basically creates a tripping stops, and if that happens, we usually have a strong buying or selling. It removes the defenses to the upside or downside, and it basically creates so-called imbalance to the order books. Impulsive moves, because they can happen on any time frame, and because they create imbalance on the order books, they need a correction, which will surely come. Everything, as you already know, should be in an equilibrium. Okay, there shouldn't be any divergence from the equilibrium. If there is a divergence, usually the correction will happen. Okay, impulsive move usually has multiple candles of the same trade momentum in a row, and as I said, it's very good seen on Heikin-Ashi candlesticks. Using Heikin-Ashi candlesticks, of course with range bars, we can also see that this is the example of a good impulsive move, and this is the example of a downward impulsive move. Contrary to standard Japanese candlesticks, especially to traders who are pretty much new to trading, this is much easier to spot by using Heikin-Ashi combinations, and basically you can see here that this impulsive move is so strong, and only after it there is some sort of correction. This impulsive move is so strong, and this is a correction. Usually first correction after the impulsive move will give us great number of pips, at least for a scalp or scalp swing trade. Okay, I prefer to do scalp swings after correction moves because I expect another leg of impulsive moves. Okay, so Heiken Ashi candlesticks are pretty useful to that. This is the example of standard Japanese candlesticks, and you can see the difference between Heiken Ashi. It's much easier to define impulsive moves because, as we already covered Heiken Ashi in our previous webinars, now that is why it's very important for you to attend every single of our webinars, because we always connect previous knowledge with current knowledge. And you know already what Heiken Ashi candlesticks are, and you can see it here that Heiken Ashi are color coded, and when we have white bullish candlesticks, that means that there is a trend and there is a momentum within the move. That means that the move will continue until correction happens, and red candlesticks in this example are giving us a correction of the price. It's very important to use trend lines when you are trading, of course, Heiken Ashi candlesticks. This is another example. Okay, this is another example, and you can see this was basically what we had today on euro dollar. Okay, euro dollar is pretty much, I can say it has a correction at the moment, but from this point 110.65 it had a great impulse move towards this point, then there was correction, then there was another impulse move. But you can see, in contrary to Heiken Ashi candlesticks, basically you can see it here that it's much easier to read this chart than this chart. Now this standard candlesticks, you need to have some experience in screening time and both charting, so that won't be a problem. But sometimes there is a problem for new traders. They cannot distinguish impulse moves and correction moves. Okay, I will refer to this a little bit later. Okay, so this is clear, right? We can proceed to next slide. Corrective moves. Corrective moves are usually slow and grindy market moves. It means that price is usually still in a trend, but do not forget, corrective moves happen during the trend. They happen during the trend. Corrective move does not necessarily mean that there will be reversal. There is a pattern which says trend, correction, trend, correction, trend, correction, then maybe reversal. Start of new trend, correction. Okay, that is the pattern: trend, correction, reversal. We cannot have reversal before correction happens. Remember that. Correction is retracement. Okay, is retracement within a trend. When that retracement is deep, we call it a deep retracement. When this retracement begins to break daily levels of support and resistance, we can then call it a reversal. Daily close below 10.65, daily close below this level will signify a reversal of the bullish trend on euro dollar. Okay, correction as the price needs to stay in equilibrium. It's a standard retracement in the trend because the price needs to stay in equilibrium. If there is a disturbance of equilibrium or there is some deviation from it, there is always a retracement. When correction is over, trend is back. The only exception is when important levels are broken on daily chart, that can be a sign of a reversal. Another Heikin-Ashi chart where you can clearly see impulse moves and corrective moves. We have a good trend line here, and as long as the price was above this trend line, we could see an uptrend in this pair. Okay, you can see impulse moves, correction, impulse move, small correction, impulse move, small correction, impulse move, small, impulse move, correction. I have marked it here. Now watch the pattern which I explained: trend, correction, reversal. Okay, this is the trend above this trend line, right? Trend, correction, trend, correction, trend, correction, trend, correction, trend, correction. Look at this. This spot is what? Does anyone know the answer? What is the point of this spot which I have marked with a circle? What does it represent on the chart? Does anyone know? If anyone knows what it represents, just type your answer, okay? I don't see any answers, guys. Are you following me? Okay. No, it's not indecision. It's not indecision. Okay. Yes. No, it's not correction, guys. Yes. Now we have a correct answer. The correct answer is end of trend. Yes, end of trend. Okay. That is correct answer. That is the correct answer. Okay, trend change. Exactly, Bogumi. Michael, you're right. That is the end of the trend. Exactly. That is why I also encourage you to pay attention to Heikin-Ashi. Easier. So, you see, this is trend line which was broken at this point, retested. Now, you can see, this is impulsive move. So, this is a pattern. Trend, correction, reversal, trend, correction, and at this point reversal. This impulsive move makes a new trend. So after reversal there is trend again, but now the correction is to the upside. Look, now correction is to the upside. Corrective move, impulsive move, corrective move, impulsive move. Okay, that is how it goes. Okay, now I'm testing various setups using range bars and Heikin-Ashi in combinations, and they very clearly produce the picture of these moves, corrections, impulsive moves within a trend or a new trend. So this is clear example how it goes, and you get the picture now, right? This is the example here again. Very easy to spot, guys. We have a look, this is 3 touches of a trend line, and we have uptrend, then correction, uptrend, correction, uptrend, correction, uptrend, correction. Zigzag, right? When this trend line is broken, we have retest, then impulsive move, small correction. So this is the beginning again of a downtrend. Okay? This is my analysis of euro dollar which I did today, and the price exactly came to this spot here and it rejected towards this level here. Looking at bigger picture, we are still in uptrend even if the price breaks here and jumps again until this daily close below 1.1065 is spotted. When we spot a daily close below this spot here, daily close, that will be the end of uptrend, and that will be shift of euro-dollar trend to the downside. Okay, so if you traded this move today where I posted, you could have made some 50-60 pips because you still traded with a trend. Okay, you still traded with a trend. Okay, you understand the logic behind it. Okay, now this is how it looks on daily. We can see a big impulsive move on daily chart on euro dollar. Then there was correction. Then there was another impulsive move to the downside, correction, move, correction. So again, look at the price, 10.65. We have now some sort of impulsive move on daily, 2 candles, not a big move. But still, look, this is what? A correction until this closes below this level here. Okay? Pretty much straightforward. You just need a little bit of practice. Now, I will teach you how, if you don't know how to read Heiken Ashi or you don't know how to read price action, that is why we are here, Chris and I, and other analysts at Edinburgh Markets who can help you in your trading decisions. Of course, I will show you now how you can use MACD to identify momentum and retracement. Okay? So just by looking at MACD, you can identify at least on that time frame momentum and retracement. And use two-line MACD. It's called modern MACD, and I use it every day in the analysis. You can see it, okay? You can see it on the charts, okay? The question is, Caroline is asking, so you think it's more probably to go down to test daily lows? Well, Caroline, tonight there will be UK election results around 10 GMT. It's midnight my time, so I think that the price will be volatile during that time. And on Friday we will have NFP. So if there is a big surprise in both UK elections and NFP, we can see a lot of things happening. So at this point, stick to intraday, because on intraday we have already had some moves happening. Okay, we already had a bounce from point of confluence. I posted that analysis on Forex Street, and you could have read it. I also tweeted it a couple of times. So stick to it. If it breaks 12.30, it has the possibility to go to 1.1150, where my pending order buy is waiting for. So we will see. There is a lot of fundamental data releases in near future, so we need to be careful, guys. This is how I spot and how you can spot trend momentum by MACD. This is zero line. Pay attention now. If blue line is above red line and both are above zero line on MACD, we say that the price has buy momentum. Okay? So price has buy momentum, and usually that is a trend. Impulse move. Maybe the impulse move. But if blue line is below red line and both are below zero waterline, we have a sell momentum. So the price will go down, right? Now, if blue line is below red line and both are above zero line, we say that the price has lost its buy momentum and that is retracing. Usually that signifies that we still have uptrend, but the price is correcting in uptrend. If blue line is above red line and both are below zero waterline, we say that price has lost its sell momentum and that is retracing. So it's still a downtrend, but we have a retracement. What is very important is check higher time frames. If you are watching this on 1 hour time frame, check 4-hour and check daily time frames to see what MACD is showing you. That is how you can align trends, momentums, and corrections. Okay, that is how you align trend with momentum and correction. Okay, this is the example without MACD. Okay, so you can see a downtrend. This is a correction here or retracement. It's called deep retracement. And this example is basically by using, look at this, weekly chart. And when we zoom on to daily chart, we can see this is clear downtrend. And same candle on daily shows downtrend with retracement. Okay, because red line is above blue line on weekly, so it's big downtrend, but on daily blue line is above red line, so it's still downtrend, but there is retracement at this point. So use multiple time frames to scan through MACD, and you will see usually how it clearly shows you retracements, trends, and that is a little trick you can use. Okay, now guys, if you have any questions, you can ask me. I showed you basically how you can use MACD to spot retracements, momentums, and probable impulse versus correction moves, and how you can use Heikin-Ashi to define impulse and correction moves. Okay. Jen is asking, what time frame is that of trend? If we see a daily close below 1065, daily close below this, then we should look for short setups. Now we are looking for long setups. Okay, still. Okay, I don't see any question now. Any advice how to trade cable between tonight and tomorrow? I would sell cable if it goes to 53.30 and my stop is 53.65. I don't think that cable should go above 53.65. So I probably will be shorting on rallies. Okay. But again, the thing is, if there is a probable hung in the parliament, so if there is no majority, cable should be sold. But if there is a majority, then initially I expect 53.30 to be sold, but then there can be a possible long. So we need to see what results will be. I cannot speculate. That is very serious thing, so I cannot speculate about cable. At the moment, I am sure on rallies, but we will see. If they can manage new parliament majority, I think the cable will continue with bullish trend. So we will see what results will be, so do not speculate about it. Do you have any level which cable can be bought? Not at the moment. 51.60, Jen, if you followed my analysis, 51.60 was the level for buy, and it happened 2 times already, so we need to wait for results. But 51.60 is the level to buy. What it could be sold if we get hung parliament? 53.30 is the level to sell with 53.65 stop loss. So can you type the cable? Okay, I'm looking for 53.30 as 153.60 should hold if there is a stalemate in the parliament. Okay. Okay. So I typed it over. So 153.30 as 153.60 should hold if we get a hung parliament. Okay, again, send. Okay. Okay, I don't see any questions. Okay, let's see. How to know when correction becomes reversal? By using higher time frame analysis or Heikin-Ashi, as I explained. Okay, this is the answer to your question. So guys, let's see what will happen. This webinar, of course, is being recorded, so it will be uploaded on Admiral Markets YouTube channel. So there will be a volatile night ahead of us. Tomorrow we will do another analysis. Of course, sign in for new webinars, weekly Forex recap on Monday. Do not forget, I will be posting new trades and of course live trading lab with Chris. We will see what can happen, but pay attention to 53.30, 53.60 on cable, 51.60 also on cable, 12.30 on euro dollar if it drops 1.1150 on euro dollar. So those are the levels. Okay. So guys, thank you for comments. Thank you for your questions. We'll be here again. And of course, do not try to make any positions now. It will be very, very volatile, guys. So as I always say, cheers and trade safe. We will talk very, very soon. Okay? Trade safe.